Hey Rich Girls, Kirby here. Welcome to another episode of Rich Girls Guide. Today we are kicking off a 4-part series all about 401ks. Since a lot of us are currently going through open enrollment, I figured 401ks and contribution amounts for 2024 are probably the closest to top of mind for most of us as they ever will be throughout the year. Questions I used to get all the time in wealth management: how much should I contribute to my 401k? What should I be invested in? How is the money taxed? What happens when I change jobs? So I decided, why not do a deep dive? I started writing out all of the points that I wanted to hit and realized this was not going to fit in just one episode. Before we dive in, I just want to say a huge thank you for tuning in today. If you find this information helpful and want to support me so that I can make more content for you, please follow wherever you are tuning in right now. And a super quick reminder that you can view these in video format on YouTube and Spotify. Please note, this is not financial advice. This is simply my opinion and should be used for entertainment purposes only. Like I said, today's episode is going to be part 1 of a 4-part series on 401ks. We'll go over why we need a 401k to begin with, how they actually work, and some tips and tricks you should know when setting up or making changes to your 401k. Really quick, for my self-employed boss babes and those of you who may not have a 401k option through work, I will go over what your options are at the end of this episode. And I'll go ahead and put a timestamp in the show notes so that you can skip ahead to that part if you would like. Let's start with the basics, shall we?
Let's not, and say we did.
What is a 401k? A 401k is an employer-sponsored retirement plan that allows employees to put money away for retirement. The Internal Revenue Service, or more lovingly referred to as the IRS, has what is called the U.S. Internal Revenue Service Code. This code outlines all of the rules and regulations that the IRS mandates U.S. tax filers, you and I, to follow. Section 401, paragraph K of the code outlines employer-sponsored retirement plans, hence the term 401k. As an aside, the IRS continually updates and adds to their code throughout the year, every single year, which is why it is so important to keep yourself up to date on the changes made. If you have a complicated income situation, it is never a bad idea to reach out to a trusted accountant or CPA in your area. Paying an accountant now is much better than paying the tax man later. Now, there are different kinds of retirement plans an employer can offer. Simple IRAs, for example, are meant for small businesses. SEP IRAs are meant for self-employed individuals. 403Bs are offered to teachers, and 401ks are generally utilized by companies that have more than 100 employees. Since most people have a 401k, that is what I will be focusing on in this discussion. Just know that a lot of the overarching themes will overlap between all of the different retirement plans. The IRS allows you to put a certain amount of money into a 401k each year. And that money gets special tax treatment. This is essentially the IRS trying to incentivize you to save money for retirement. Now, why exactly would the government be encouraging us to save for retirement? This is most likely due to the fact that pensions are a thing of the past and Social Security is not guaranteed for anyone under the age of 55, or honestly, anyone, period. Even if Social Security is around by the time you and I retire, which I highly doubt, the amount that is paid out in comparison to what you earned while you were working will not be enough to continue the same lifestyle in retirement. So the onus is on us to save money so that when we do retire and we stop receiving a paycheck from our employers, we can start to pay ourselves out of our retirement accounts. Okay, so we know why we need to start saving for retirement. Now comes everyone's favorite question: how much should I be saving for retirement? I am actually going to save that question for the last episode in this series, where we will figure out exactly how much you should be putting into your retirement accounts every single paycheck. I will help you calculate it, but that will be the 4th episode. For now, there are 2 quick rules that you should follow. If you are starting to save while you're still young, let's say in your teens and early 20s, if you're putting away between 10 to 15% of your income into either a 401k or just some kind of retirement account every single year, you will be golden to retire and continue your same lifestyle once you hit 65. Now, if you're starting to save later in life, you will need to start increasing that percentage. If you don't start saving until you're 30, let's say, you'll want to put away closer to 15 to 20% of your income. If you're getting closer to 40, you'll really want to put in a minimum of 25% of your income every year, so on and so forth. Obviously, this will get increasingly more difficult the older you get. Not just because you'll have to put in such a larger percentage, but also because there are certain limits on how much you can put away each year. Again, we'll go through the calculations together on the last episode of this series, which should be dropping the 3rd Monday in December. The second quick rule is if you have an employer match, you should absolutely 100% take full advantage of that match. Now, a match is optional for employers, meaning they do not have to offer one. Most employers who have a 401k do tend to offer a match, both as an incentive to attract and retain employees, and because they can write off the cost come tax time.
I'm thinking of bringing homeware into the store, so that's a write-off.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah, it's when you buy something for your business and the government pays you back for it.
Oh, and who pays for it?
Nobody. You write it off.
Who writes it off?
I don't know. The write-off people.
There are 2 main types of matches: full matching, also known as dollar for dollar matching, and partial matching. Dollar for dollar matching is exactly what it sounds like. For every dollar that you put into your 401k, your employer will also put in a dollar, up to a certain percentage of your income. If your employer says they will match dollar for dollar up to 4%, or fully match up to 4%, that just means for every dollar you contribute to your 401k, they will also contribute a dollar, up to 4% of your income. If you make $50,000 and want to take full advantage of the match, you will want to contribute $2,000 annually to your 401k, which means your employer will also be contributing $2,000 to your 401k. Now, you can absolutely put away more than 4%, but in terms of matching, your employer will not be putting in any additional money over that 4% threshold. Now, if your employer says they will partially match your contributions, that just means they are not putting in a full dollar for every dollar that you put in. They might say something like, we'll partially match 50% up to 4%. Let's break that down. If they partially match 50%, that means they will put in 50 cents for every dollar that you put in. That next part, up to 4%, is the same as our previous example. They will match up to 4% of your income. With a partial match, in order to max out the amount your employer will put into your 401k, you will need to back into how much you need to contribute. Let's say you're still making $50,000 and your employer matches 50% up to 4%. That means the most they will contribute into your 401k is still 4% of your income, $2,000, the same as our first example. The difference is how much you have to contribute in order to get that full match. If they are only contributing 50 cents on the dollar, that means you will need to put in twice as much to get the employer match. So you will need to contribute 8% or $4,000 in order to receive the maximum match of $2,000. If you only contribute $2,000, then your employer is only going to contribute $1,000. 50% of your contribution. Matches are awesome and a great way to maximize your retirement savings. But, and there's a big but,
Wow.
That's a pretty big butt.
If you want to keep your employer match, you have to know what the vesting schedule is. The vesting schedule is essentially a timetable that tells you how much of your employer match you get to keep depending on if and when you leave your employer. The longer you stay at your job, the more of the match that you get to keep. These can span anywhere from 1 to 6 years, and typically if you stay at a job any longer than 6 years, you are entitled to receive 100% of the employer match. Let's take a look at the long end. A vesting schedule of 6 years. This would mean that after 1 year of service, you are 0% vested. If you leave before your 2-year anniversary, you will not receive any of your employer match. If you leave after the 2-year mark but before the 3-year mark, you will receive 20% of your employer match. You get the idea. So after year 6, you are entitled to keep the entire employer match, 100%. Again, vesting is only applicable to the employer match, not on your contributions. Any money that you put into your 401k, you are always 100% vested in that. It is your money. They cannot take it away from you. This is just another way of enticing employees to stay with the company and reward those who do stay. You might be thinking to yourself right about now, Kirby, this is great information, but where in the actual do I find out my matching investing schedule? I would recommend reaching out to your HR rep to see if they know off the top of their head, since they typically help out with 401k maintenance anyways and are usually well-versed in the matching and vesting schedules. If you are already enrolled in the plan, you can also reach out to the financial representative that is listed on your statement or on the 401k website, and they can typically tell you everything you need to know about the plan. Now, your vested account balance is actually pretty easy to find if you're already enrolled in the 401k. You can usually find it right on your statement, and it will typically separate out your total account value versus your vested account value. Okay, so we know what a 401k is. We know why we have to save for retirement, and we have a rough idea of how much we should be saving, or at least the minimum amount to max out your employer match. Now, some of you will have a choice to make, a fork in the road, if you will. 2 roads diverge in a yellow wood. Should we put away money pre-tax or after tax? Pre-tax would be putting your money into a traditional 401k. And after tax would be putting your money into a Roth 401k. Now, some of you will actually not have that second option. Employers are not required to offer a Roth 401k option at this time. In that case, your choice is pretty easy. If you don't have a Roth option, then your only option is pre-tax or traditional. If you put your money away pre-tax, that just means that you are going to owe less in taxes now. You are essentially telling the IRS that you are deferring to pay tax on that money until a later date. For those that have the Roth option, if you choose to put your money in after tax or into the Roth 401k, then you are opting to pay the tax on the money up front right now so that you don't have to pay tax on it later. I did a super in-depth explanation on the difference between traditional and Roth in my previous episode. To Roth or not to Roth. If you need some more explanation on the difference between traditional and Roth, please go check out that episode. Even though I'm discussing IRAs in that episode, from a tax perspective, IRAs work exactly the same as pre-tax and after-tax 401ks. 2 quick things to note here. If you are a high earner, let's say a doctor or a dentist, that might be having to play catch up in retirement savings after years and years and years of school, I would highly suggest talking to your accountant about putting a significant portion of your 401k money into a Roth 401k. Since you are technically not allowed to make Roth IRA contributions, although there is technically a backdoor option available, Roth 401ks are another way that you can utilize saving for retirement, even though you make a lot of money. You are also able to split your contributions between pre-tax and after-tax. You do not have to put all of your contributions into one bucket. And that goes for everyone, as long as your employer allows Roth contributions. One important note about matching and the decision between pre-tax and after-tax: employer matching will always 100% of the time be pre-tax traditional money. Even if your employer offers Roth contributions and you only make Roth contributions, all of your employer matching contributions are considered pre-tax. Remember, your employer gets a tax write-off on those matching contributions, which means the IRS still needs to get paid on that money. A quick note for my high-earning listeners that are over the age of 50, if your employer does not currently offer a Roth 401k option, I would highly recommend shooting them an email and encouraging them to do so. There are going to be major changes to 401k contributions for higher-earning folks starting in 2025. And if your plan does not allow for Roth contributions and you fall into this higher earning category, you could potentially be majorly screwed, especially if you are banking on utilizing that catch-up contribution. I will link an article in the show notes for you, and let me know if you want more in-depth information on this rule change. What happens to your 401k when you leave your job? As younger generations tend to change employers more frequently than previous generations ever have, the question of what to do with old 401ks has skyrocketed. According to an article by Zippia, who cited the U.S. Bureau of Labor and Statistics, they said, quote, workers aged 55 to 64 had an average tenure of 9.9 years, end quote, while, quote, workers aged 25 to 34 years had an average tenure of 2.8 years, end quote. That would mean workers that are currently 25 to 34 years old would have roughly 14 to 15 different jobs over a 40-year career. That is crazy. So back to the question at hand, what happens to your 401k when you leave your job? Assuming you are going to work for another company that has a 401k option, you have three main options. First, you can leave your 401k at your old employer. Second, you can roll over your old 401k into your new 401k at your new employer. And third, you can roll over your old 401k into an individual retirement account, or IRA, at any financial institution you would like. Now, you do technically have a fourth option. You can fully distribute your 401k, pay the ordinary income tax on the full amount, plus pay a 10% penalty on your distribution, and do whatever you want with that money.
Girl, don't do it. It's not worth it.
For the love of all that is holy, do not do this. You have already done the hard work to save your money. You're doing the hard thing already. Do not mess it up now by taking a distribution and blowing it before you retire. I have yet to meet a person that has taken any kind of distribution from their 401k and not regretted it later on. And unfortunately, I saw a fair amount of people do this when I worked in wealth management. If you are someone who hates to see the market go up and down and are worried that it's not earning you enough money, please tune into next week's episode. We're going to dive into the stock market and looking at long-term results over time that will help you be able to retire so that you do not have to work up until your deathbed. Let's go over some pros and cons for the three feasible options that I just went over. First, leaving your old 401k at your previous employer. In the short term, this is obviously the easiest solution. You do not have to take any immediate steps to roll it over to another account, and it will stay invested in whatever you had selected for your investments previously. You can essentially just set it and forget it. Which brings me to the first con, the forget it part. While this probably sounds crazy, because it is, you would be shooketh to know how many people have literally forgotten about old 401k accounts that they own. I know it's hard to fathom, but somehow I would come across this every single year when I worked in wealth management. While I could not find a reliable figure on the number of Americans that have forgotten accounts, I did find an article on Bankrate that said, quote, "These forgotten accounts held assets worth 1.65 trillion in May of 2023, or about 25% of all 401k assets," end quote. Yeah, that was trillion with a T. I'll link the article in my show notes because it also outlined a ton of information and helpful links on where to go to try and find old 401ks if you think you may have one floating in the ether. All right, this brings us to our second option, rolling over your old 401k into your new 401k. This is a great option. By rolling over your old account, we are eliminating the possibility that the old account will be forgotten. Another pro is that we are still able to utilize cheaper mutual funds than we typically would have access to in an individual retirement account. If we are utilizing this option, please do what is called a direct rollover. A direct rollover just means that your old 401k is handing funds directly over to your new 401k. By doing a direct rollover, this ensures that you will not pay any taxes or owe any penalty on your 401k assets in the given year. There is a such thing called an indirect rollover, in which the old 401k company, instead of handing it directly to the new 401k, hands it to you. If this happens and you do not hand the money over to the new company within 60 calendar days, you will owe tax and penalty in the given year on all of those funds, and they can no longer go into your 401k. If you have the option, always opt for a direct rollover. Super quick side tangent because I know I'm going to get a DM about this. Some people utilize this 60-day indirect rollover window as a loophole to essentially get an interest-free 60-day loan, typically by taking it out of an IRA and then putting it back into the same IRA within 60 days. While legally you can do this, just know that it is super, super risky. I have personally only seen a small handful of people do this correctly and put the funds back into their IRA within the time frame that they needed to. Now, there's only one con for this option that I can think of. You are limiting your overall investment options. 401k plans typically have a very small number of investment options. Anywhere from 20 to 50 different mutual fund options is what I've typically seen. While that may sound like a lot, if you were to instead roll funds into just a regular IRA, you would have thousands and thousands, if not hundreds of thousands of options to choose from. Again, we'll go over investment options and the market in next week's episode. Now, the third option is my favorite and one that I personally utilize. Rolling over your old 401k into an individual retirement account. You are still receiving the tax benefit of not paying tax or penalty on your old 401k in the given year by completing it as a direct rollover. You have also eliminated the possibility of your old employer taking possession of your funds and severely decreased the possibility that you will forget about the account. You have complete control over this account. You can choose to open your IRA at whatever financial institution you like the best. You can pick out whatever investment options you would like instead of having to choose from the handful of pre-selected options that the 401k plan allows. And you can continue to add funds to your IRA or do future rollovers into this account. I like to think of it as having two different retirement buckets. One is my current 401k at my current employer, and the second is my IRA. Each time I leave an employer, I can roll over that old 401k into my IRA and then open a new 401k at my new employer. You do not need to open a new IRA each time you complete a rollover. multiple 401ks can be combined into your single IRA. Now, one thing to note is you may need to have two separate IRAs, one to hold your traditional pre-tax funds and another that holds Roth after-tax funds, if that's something that you had opted to do. While 401ks can hold both traditional and Roth funds in a singular 401k, IRAs have to be separated out for tax purposes. So at the most, you will have 3 accounts to keep track of: one current 401k, one traditional IRA, and one Roth IRA. Not that bad in my book. For my self-employed boss babes and those of you without a 401k through work, I got you, boo. If you are self-employed and you are the sole employee, you have 3 main options for funding a retirement account. The first is just a normal run-of-the-mill IRA. If you're under the age of 50, then the contribution limit, the amount of money you are able to put in, is capped at $6,500. So as long as you are young and that $6,500 limit is around 10 to 15% of your income, then I would stick with just funding either a Roth or traditional IRA. That is going to be your easiest and cheapest option. This also applies to my working listeners who do not have an employer-sponsored plan through work, whether they just don't offer it or you're only a part-time employee. You can still open up just a normal IRA and max it out each year that you are able to. The second option for my self-employed folks are what's called a SEP IRA, which stands for Simplified Employee Pension Plan. Now, I know this gets a little bit confusing because it is technically called an IRA, but this is not the same as a traditional or a Roth IRA. Essentially, a SEP IRA is meant to be a cheaper, easier way for self-employed or small business owners to maintain a retirement plan for themselves without going through the hoops of creating a full-blown 401k. 401k plans tend to be more expensive, more cumbersome, and a lot more paperwork to keep up with year over year. Here's the catch. If you are a small business owner and you are the only employee, and you want to contribute more than $6,500 a year, and your income for the year, taxable income, will be over $26,000, then a SEP IRA is probably your best bet. This is because SEP IRAs have much higher contribution limits than your normal IRA does. Since it is technically a retirement account through your employer, you can make employee contributions, employer contributions, and profit sharing contributions. All you really need to know is that for 2023, the limit on contributions into a SEP IRA is $66,000, a tad over the $6,500 limit on your regular IRAs. The catch here is that you can only contribute up to 25% of your taxable income. So if you report, let's say, $100,000 of taxable income this year, then you can only contribute $25,000 into a SEP IRA, even though the hard limit is $66,000. The last thing to note is that you can only make pre-tax contributions into a SEP IRA. The third option is called a solo 401k or an individual 401k. These are suitable for those of you who are self-employed and you're the only employee. If you want to make more than the $6,500 IRA contribution limit, you are a high earner, and you want to be able to make Roth or after-tax contributions. Whew. That was a long one. While a solo 401k is definitely more expensive and time intensive than a SEP IRA or a regular IRA is, if you are dead set on making Roth contributions and you want to be able to sock away a lot of money for retirement, this is by far your best option. I have seen this really be helpful for those self-employed folks who make a ton of money who maybe did not start saving until later on in their career. I'll drop a few links below that give detailed information, but I would highly recommend reaching out to your CPA or getting a CPA if you intend to go this route. For my self-employed folks, this video is already absurdly long, so if you want me to go more in depth on the topics I just mentioned, please let me know. I would be more than happy to focus on you for a full episode. Just let me know what your questions are. Well, I think that wraps up this week's episode. Again, next week we're going to be going over the stock market and actual investments within your 401k. If you know someone who could use a kick in the pants, please feel free to send them this episode. If you have any questions, you can comment on YouTube, and if you want your question to be featured on an upcoming episode, ask away at the link in the show notes. Keep it rich and see you next Monday. Want to support me so that I can continue then creating a SEP IRA. While they might, since they typically help out with 401